Today I'm joined by Max Vermorken, CEO of SigmaRoc. Welcome, Max.
Thanks for having us.
So for those who don't know SigmaRoc, could you give us a sort of high-level overview of what the company's products are and whereabouts you sit in the industrial ecosystem and value chain?
Yeah, absolutely. So we're a minerals business out of Europe. The focus of our mineral is limestone. Now, most people will actually know what limestone is, but not realize that they do. So pyramids, big monuments are all built out of limestone. It's a fantastic building product. The feature that it has is that if you grind it down or if you heat it up, it becomes a chemical. And then it finds its way into basically everything you touch and do on a daily basis. Steel, metal, glass, ceramics, toothpaste, medication, tablets. All of that is based on some form of limestone and lime. We make those products, not the products themselves, but the fillers, the powders that go into that, out of 50 plus quarries across Europe, and then out of another 50 or so production plants in 15 countries. It's an essential product. It is really relatively unknown. It's a tiny input into big industrial processes. And so sometimes you could say that you need oxygen and water to live. I always say you need to have some limestone to live comfortably.
The equity story of SigmaRoc is kind of split into two separate parts at the minute. You've gone through a integration phase, which is recently complete, and now, which you mentioned in the most recent results, the company is now ready to scale. What have you done in the sort of last 12 to 18 months to get through that integration phase, and why do you believe the company is now ready to take that next scale of growth?
Yeah. So the big event that happened in 2024, beginning 24, was the acquisition of a whole series of assets out of the CRH group, fantastic cement group. And that allowed us as a small limestone player to basically become one of the larger operators in this sector in Europe. So there's another bigger one than us, Loast, and there's a few smaller ones. We have a really good space there. And that integration work was quite a big job. It took us the best part of 24 and part of 25 to get all these various components of €1 billion deal, if you take it all together, to function. Extract synergies, 40 million out of synergies, all that's now complete. So we have now a very well integrated, well set up business that can now take advantage of this platform, of its synergies, of its scale, of its people, to expand. And that expansion is mostly acquisition work. There's lots of smaller players around the market that we can buy, that we can fit into our group. Some organic in terms of volume growth, organic in terms of plant build. So those two facts. So we really made in our results, we said, look backwards and you'll see integration and synergy delivery. Look forwards, you'll see M&A and growth.
In the F25 results, you spoke about the fact that a lot of the volume decrease was deliberate. What were some of the reasons behind this? And as sort of markets start to recover, what level of volume would you want to regain, or are you kind of happy with the more sort of solid product mix?
Yeah, so we did flag about 1.5 million tons of volume reduction, and you correctly state this was deliberate. Limestone quarries, they're fairly abundant, but the higher grade quality that we have is also quite rare. And so from our perspective, we have a margin strategy. We want to sell that material well. You can only sell it once. You have to extract it. A whole bunch of cost goes into it. You can sell it once. And so some volumes would just made no sense for us at all to sell, because you were using a high grade, pristine material as a basement fill in a construction project. Makes no sense. There's that. There's also some plants that were just in the wrong place. If you combine two big groups together, as we did with the CRH deal, and then it suddenly becomes redundant to have that location still running. So those were shut down and you automatically lose some volume. So that was basically the logic. If we look forward, and we did some analysis with a big consulting group on this, we'd be quite happy with 1.5% volume growth CAGR, that is over the next 5 or so years. That would recognize some of the growth, the comeback of construction. It would recognize some of the protection that Europe now puts on its own industry, steel and other industries, minerals, mining. So if we see that 1.5% over the years to come, we'd be very happy.
2025 was a strong profit year for SigmaRoc. You kind of had an EBITDA margin of about 25.5%, despite a softer underlying demand. What's your outlook on the durability of these margins, or is the company now just at a higher profit margin?
Yeah, so there's two answers to that. So on the one hand, we did an enormous amount of work on our cost base. And so the cost base, we took 40 odd million of cost out of the group across the year 25, which is a fairly big number on 250 odd EBITDA. And so that cost base has obviously meant that the margins go up. Now, as we recover, hopefully with some extra volume growth, the drop through of those new tons will be at a higher margin than our 25%. So you could see just that adding margin further, right? So you will see the margin go further up. Now, there's obviously cost pressures always that we need to manage. For example, oil is clearly more expensive. Energy inputs are more expensive. Labor typically goes up. There's inflation. So those things we also need to manage through the cost base going forward. We typically do that fairly well. There's operational efficiency gains that we still can get to. We have done the integration, but once you do the easier bits first and then the more difficult things later. So that's still to come. There's, as I said, the drop through of the additional tons that is coming. So net, I would suggest that these margins will continue to move forward by the things that we can do ourselves and hopefully a bit of recovery.
Taking a step back to your capital allocation moving forward, what are the sort of key things that you think are going to help drive the business and scale? Is it kind of traditional bolt-on M&A? Is it organic growth? Is it reinvestment in certain areas? And then how does your sort of balance sheet perspective with the refinancing you've done kind of play into that?
Yeah, it's a very good question. So obviously the balance sheet is in great shape with that refi. If you look back, we've had an average multiple paid for deals of about somewhere between 6 and 7 times. And then we have increased the EBITDA on those deals by an average of about 40, maybe a bit more, 40%. So you take that, you buy something for 6, you run it at 4, right? That creates a huge amount of value for the group, especially if we trade at sort of these sorts of multiples or higher. So for as long as we're in that space, it makes a lot of sense to take the capital that we generate from the activity and then reinvest in acquisition work. Sometimes you try to do this organically, so you build a new plant. The trick with our industry, however, is you do that in the wrong way, you destroy the market for everyone because there's just overcapacity created and nobody makes any money and you basically killed your own company. That doesn't make any sense because we need obviously the profitability to sustain the reinvestment we do to maintain the plants and so forth. So it's a fine balance between mostly M&A and then some organic work. People ask us, why don't you just buy your own stock back? I mean, this is a great business. This should be worth 8 times, 10 times, whatever the numbers they want to put on it. Why don't you just buy your own stock back if you're below that? And the answer to that is yes, that could be an answer too, as leverage comes down and as we have more capital available. But the story of M&A and integrating and expanding that base and taking value out of those companies, which continuously give you more upside, is very attractive. And so that's probably the first way we are using that capital. And if we then still have excess cash available, then obviously buybacks first and dividends maybe afterwards.
Central part of the growth strategy is the policy and tailwinds and how that begins to translate into demand. What are some of the current tailwinds that are already visible and what are some of the other ones that you're excited for but a bit further out?
Yeah. There's a few things that obviously we flagged. There's first and foremost German stimulus. Everybody looks at that. It's an enormous package. It requires time to be put into place and then translated into actual cash spent. That is going and that's happening. In terms of where we see it from our customers, they start to get inquiries, they start to get projects that are being funded through these sorts of structures. Hasn't translated in tons out the gate for us yet, but we hear it in the background. A second effect of that is that people feel more optimistic. They go, okay, well, the government's doing something for the economy. We can now move, we can invest, we can go. That started to happen at the end of last year and through last year. That started to happen and get the German economy in a better place. You can see that through the PMI indices in Germany as well. So those are the first ones that are clearly flagged that we see that aren't there yet. One that is there is, and has already had effect, is the steel tariffs and quotas. This is critical, and this is the European Union starting to recognize that the world is a global place. We compete with places that have low energy cost, low labor cost, and if you don't protect your industry, it will not survive. You see this in steel demand. So German steel demand production is up. Polish steel production, that has to do with some switch offs of plants or whatever else, but is there. Scandinavian production is up. So across Europe, where we supply into the steel industry, we have felt that additional demand come through. So that's a clear effect of a policy that's already there. There's also the critical minerals policies that come out of the European Union, where it's like, okay, there's some minerals that we need to make ourselves through mining. In Finland, for example, where you do a lot of mining in the north. So that's another one that we can see already having effect on our end demand. So we're very happy that the governments in the European Union finally take this seriously and help indigenous industries get through tough patches.
Amazing. Thank you very much for speaking to us today, Max.
Well, thanks for your time.